Good morning. It's Jeffrey Christian of CPM Group. It's 10:45 in the morning here in New York on Friday, the 31st of October. I want to talk about gold, silver, platinum, palladium markets, where we are right now. And then I'll talk a little bit about the Fed's, what I'm calling the warning shot, an announcement that was perhaps a little bit overlooked by some people. Some people picked up on it in the FOMC statement on Wednesday. Gold, silver, platinum, and palladium prices have been sort of consolidating. They rose very sharply in the first 3 weeks of October, especially 2 weeks ago. They shot up. Gold went from, gold started October around 3,800 or so, shot up to 4,400. Most of what in 1 week came down to around 4,000 in 1 week, and it's been trading on either side of 4,000 this week. It's consolidating. In our market committee, which is the group of us that talk about precious metals and come to a consensus as to what our views are, short-term, medium-term, and long-term for precious metals prices. In our meeting yesterday, one of us thought that the price was likely to rise back toward 4,200. One of us thought that the price was likely to fall toward 3,800. And one of us thought that the price would probably fall to 3,800 and rise to 4,200. In other words, the volatility seems likely to continue, and we're at a critical point. If you look at it from a fundamental perspective, if you look at what's been happening with investment demand around the world as the price rose and then people were taking profits and the price came off, you had a lot of short-term, non-traditional gold and silver investors come into the market, momentum traders, short-term speculative people saying, hey, the price of gold's rising, the world's going to hell in a handbasket, I'm going to ride this train. Price got to 4,400. It stalled out just below 4,400, and they took profits, and a lot of them have now left the market. Unfortunately, the commitment of traders reports are not being produced because the U.S. government shut down, so we don't necessarily see that indication in the commitment of traders reports, but you can see it in other data that's not produced by the U.S. government or collated and released by the U.S. government. So we've seen that, and we're at this critical point where the price is consolidating. It could easily spike much lower. It could easily go back up. Part of that's going to depend on the economic and political environment and what happens that sort of causes people to either relax a little bit of their concerns or strengthen and renew and increase their anxiety about the state of the world. We've seen various statements this week. A lot of the statements don't hold up to reality and scrutiny. President Trump went and met with President Xi in Asia. They have an agreement to agree, relatively weak. I'm sure that the Chinese government and Chinese people are looking at it as something that Trump paid homage to President Xi in China and agreed to back off from some of his more onerous things. And the Chinese said, sure, of course. But it's an agreement to agree. There's a lot of things that are not resolved. And a lot of the agreements that we've seen recently have been along those lines. So we're still in a place where it could go either way. The U.S. government, meanwhile, continues to be locked down. We've probably knocked off 0.8% of a percentage off of our annual GDP. It's about to get worse, and there seems to be a total impasse between the Republicans and the Democrats in Washington to resolve this. So it's hard to say how that's going to be. It's probably going to continue the economic pain and economic concerns that we've been seeing, which have been stimulating and contributing to the strength of investment demand. Gold is, as I said, 4,309 $4,039 about 15, 20 minutes ago when we were preparing the slides. It was up about $23. It's within that range, and our expectation is that the price probably will continue to trade in that range. Could come down to 3,400, could go up to $4,200. At some point, it will break out, and it's anybody's guess which way it's going to break, because you don't know what's going to be the economic factors or the political factors. Our view is that ultimately the price will rise further because we don't see the economic and political issues being resolved anytime soon. The situation with silver is very similar to what I just described for gold. And again, it's many of the same factors that are factoring in there. Silver prices were about $48.67 when we were preparing this 20 minutes ago. That was up 5 cents from yesterday's close. You can see that the silver price continues to consolidate. And it also, as with gold, it could go either way at this point. We're watching this consolidation. Technical people who would be looking at a measured move might think that the price of silver could fall back toward $40. That's not out of the question. Fundamental people who are looking at weaker fabrication demand and profit taking in the Indian investment market, a relaxation and reduction of the supply issues in the London market, they also might think that the price could easily fall back to $42 or $40. That would still be pretty close to record prices, and it would factor in there. The idea that once the silver price rose over $50, it would shoot up to $70 or $100. Well, it didn't. It came back off to $46, a little bit below $46 actually this week. Our expectation is that the price will consolidate. It can move either direction, or it can move both directions. We expect it to continue to be volatile. Platinum prices have skipped. Platinum prices also are consolidating. They rose very sharply. We saw a measured move on the upside from June into October. It's coming off a little bit now. Our expectation also is that it will continue to consolidate. Our expectation longer term is that platinum will come off because we don't see it as tight of a market as other people see it. And we don't see it as tight of a market as gold and silver. And it is less of a financial asset. It's much more a industrial commodity, the major use of which by far is in auto catalysts. And the auto industry is not doing particularly well on a global basis. So our expectation is that longer term, the price of platinum will probably come off. We've been surprised to the upside. It's primarily been a function of shorter term investors in ETFs, futures, forwards, and options. We haven't seen a tremendous increase in investment demand. There has been some increase, but not a lot. So that's where we are with platinum, and that's where we are with palladium too. The price of palladium has risen. It is trading around $1,488 when we were preparing this presentation. Our expectation is that over the next several months, it will continue to deflate along with platinum. My last slide is the Fed's balance sheet. And you can see here, prior to 2008, 2009, the Fed had less than $1 trillion on its balance sheet. During the global financial crisis, it bought a lot of bonds to increase money supply to help the U.S. while it was in the midst of the Great Recession and the global financial crisis. And it had more than $2 trillion on its balance sheet, mostly Treasury securities. There are some U.S. government agency securities in there, and they had some other assets in there too at the time. They continued to buy over the course of the anemic post-recession recovery that lasted into 2014. We ran into a They tried to reduce a little bit around 2012, 2013, but they could not do that. And there was a crunch in the money market supply, so they had to reverse. The economy ran into some bumps after that, and they wound up buying more treasuries, increasing their balance sheet to around $5 trillion. They tried to reduce it a little bit in 2018, 2019, and they did, in fact, knock off nearly $1 trillion. But the global economic lockdown during COVID caused them to buy more, and they continued to buy more for a couple years after that into 2022. They got as high as $9 trillion, and by 2022, they started reducing that. This was the time when they were looking at raising interest rates and reducing their balance sheet. They've gone from $9 trillion in 2022 to about $6.6 trillion now. And in the FOMC announcement on Wednesday, they said that they were reducing the Fed funds rate another 25 basis points. Importantly, is after that, Chairman Powell was talking very vehemently about the fact that the Open Market Committee members are somewhat divided as to whether or not they should continue to reduce interest rates or hold them steady. There was one vote that was a Trump appointee who said that they should lower their interest rates more than 25 basis points. And there was one vote that thought that they should actually increase interest rates. But the vast majority of the FOMC said we should lower it 25 basis points, but we should be on guard for worsening economic conditions, employment, and rising unemployment and weaker employment growth, and persistent inflationary pressures in housing, in services, in energies, and in food. Primarily, but really across the board. So the Fed, as Chairman Powell said, no one should be convinced and take it as a given that there will be another interest rate cut in December. We have to see how the economy is going. And right now they're flying in the blind because there's a paucity of government statistics on economic conditions for the third quarter and October due to the government lockdown. But they had reduced their balance sheet about $2.4 trillion over the last 3 years as part of their trying to normalize monetary policy. They have severe limitations because the government deficit has exploded, from $460 billion to $1.7 trillion to $2.7 trillion. And the Fed needs to finance that to some extent by buying treasury bonds. But what they've done is they have ended their effort, what they're calling their balance sheet reduction program. They're not going, what they've been doing, the way they reduce their balance sheet. Most of these are treasury securities and agency bonds. As they mature, they had been buying replacement bonds to finance the government. Over the last 3 years, they continue to buy bonds to replace most of their portfolio, but they have been able to slowly reduce it by not buying replacement bonds for a total of $2.4 trillion. So they've reduced their holdings of treasuries and other agency bonds by about $2.4 trillion, trying to normalize monetary policy at a time when fiscal policy is anything but normal. What they're doing now by saying that as of December 1st, they're going to reduce their balance sheet a little bit more in November, but as of December 1st, they're going to stop this reduction program and they will buy replacement bonds as the bonds that they hold mature. What they're saying indirectly is there is a tightness in the money markets, there's tightness in money supply, and the economy is growing weaker. So we need to stop trying to reduce our balance sheet and draw money out of circulation. We need to take a more neutral position because the economy is heading toward problems. I have said for years that people who talk about how the Fed should reduce interest rates should be cautious about what they wish for, because the Fed would only reduce interest rates when they see economic storm clouds on the near horizon. And they have been reducing interest rates. They've done it twice now this year, but they had done it earlier in 2024. The Fed sees economic problems on the horizon, and they are shifting monetary policy so that they will be able to be more accommodative when the storm hits. And they need to work to try to keep the economy out of a recession. The other thing I've said repeatedly is that the Fed can stanch the bleeding. It can't stop the wound. The wound is fiscal policy. It's government spending, deficit spending. That's the problem, and that's the purview of the administration and the Congress. The Fed has control of monetary policy, and it's sort of captive by the fact that the Treasury, that the fiscal policy has become so deficit oriented. The Fed has to pay attention to what the fiscal policy is doing to the U.S. economy and the global economy. So when you see the Fed lowering interest rates, when you see the Fed ending its balance sheet reduction program, that's an indication that the Fed is extremely worried about what's going to happen to the economy in the near term. And like I said, some people have picked up on the balance sheet reduction program ending in the FOMC announcement on Wednesday, but a lot of people seem to have missed it. And more importantly, they've missed the importance of what it is and what it's signaling that the Fed is seeing and expecting coming down the road. That's all I have for now. You can go to our website, you can buy our yearbooks, you can subscribe to the PMA, you can get a lot of free reads and free videos, you can read about what else we do in terms of research, consulting, assisting investors and fabricators and producers with their price exposure to commodities, including and especially precious metals and base metals and specialty metals and commodities in general. And you can read about us. In the meantime, take care of yourself, take care of those around you, try to do something good for the world, and we'll talk to you next week.